So I'm going to be talking to you about the investment journey. Okay, there are many steps in this in investing and all that, but this is like an investment journey addressing some of those steps. So keep in mind it is a journey, not a destination. All right, enjoy the journey. All right, and when we accelerate prosperity within our group, our movement, I mean, this is a very, very good place to get started because we provide lots of information you can get for free, and and helps you to get into the right mindset, thinking accelerating prosperity and all that. All right, so this is it. And think about this. Which new habits are you creating? Okay, because investment is all about the mindset, and mindset is all about the habits that you put in place. So you need to create new habits. This is why it's so important to have the Financial Freedom Fund that you fund on a regular basis, because you are creating a habit. Okay, so which habits are you creating? Okay, and then let me tackle a different perspective of investing. What about the risks with investing? Okay, I mean, there are lots of risks when you invest. So you can, so when you start investing, you must keep in mind that you can only invest what you can afford to lose. Okay, if tomorrow this investment disappears for whatever reason, can you afford it? Or were you counting on it for paying your rent or something? Okay, so keep in mind that investments, or the money you invest, is money that you can afford to lose. All right, now, with this being said, it doesn't mean that you're going to lose it, or that you want to lose it, or that you are prepared to lose it. No, it just means that if you lose it, okay, you can afford it. All right, so that's very, very important in all this. Now, some of the risks with investing are the dependence on key people. Some companies have very few people. So, of course, those people are essential for the growth of the company, for the leadership, for everything. So their dependence, being dependent on very few key people, can be a big risk, depending on the type of investment. Now, what about the operating history? This is also an important risk. I mean, and of course, I'm just mentioning the most important risks. The operating history. What have you been up to until today? What is their track record? What have you been doing? All right. So that's that is. And again, the past performance. So there is always a famous disclaimer: past performance is no indication of future gains. All right. So what you did, if you made a lot of money in the past, it doesn't mean that you're going to make a lot of money in the future. Of course, if you did it in the past, it's likely that you'll do it again in the future, but it's not guaranteed. All right. So the same thing with the projections. So you need to be careful because they are projections. It doesn't mean it's going to happen. It's that we anticipate this will happen. We expect this to happen. So we project this to happen, but it doesn't mean it's going to happen. So you need to be careful with that. Then when you invest in certain companies, and especially if they are early stage or something, well, this means that maybe there is a lack of liquidity. What does this mean? It means that perhaps you want to get out of the investment, you want to sell your position, and there's no one to sell it to. You say, "Oh, wow, I want to get out, I want to sell, I want to get my money back," but there's nobody to take over your position, to buy you out. Okay? So be careful of this risk, lack of liquidity. Another risk that is frequent is the dividend policy. Because maybe you have invested in a company that does well, performs well, has great track record, is generating profits, but for whatever reason doesn't distribute dividends, and so of course this will have an impact. You're a shareholder, you want to get some money out of the company, but if there is no dividend distribution policy in place, then you're not going to get anything. Okay, so you need to be careful with that as well. Now, another significant risk is the dilution. Let's say that you invested in a company, and after some time, the company needs more money, and you can't afford to put more money into the company, but the company raises money somewhere else. Now, because you're raising money somewhere else, they are raising money somewhere else, your position is going to be diluted. So if you had invested 1,000 in a company that was worth 10,000, you had 10%. Now, all of a sudden, the company is raising 100,000. So you are, so the company now is going to be worth, well, the 10,000 it was worth plus 100 because the cash is coming in. So it's going to be worth 110. Now, you won't have 10% of that. You put in 1,000, so maybe you're going to be worth 1%. Okay, you understand? So this is what happens with dilution. So you need to be careful with that as well. So when you are building your investment portfolio, you should always build it with these principles in mind and thinking about diversification. You know, diversification is important because you spread the risk and you can diversify through different industries and also through different types of investment plays. For instance, I mean, what we talk about a lot at the Access Club is different strategies. We have cash flow strategies and we have capital gain strategies. Now, what is the difference? Cash flow strategy is, for instance, to invest in real estate. So we buy a house and members of the club buy a house with us, and the house is being rented to some people, and those people are paying rent. And this rent is enough to cover the expenses plus to generate a return to the investors. And so that is a cash flow. So you have cash flowing in, okay? Now, if you go for capital gains, you can invest, for instance, in a startup company or in a cryptocurrency, and hoping that at some point in the future, the value of that company or the value of the cryptocurrency is going to go up. But what can happen? Well, it can go up, of course, it can stay flat, or it can go down. So you never know what's going to happen. You just hope that it's going down. And so when you are building your portfolio, you should keep these two strategies in mind. Of course, the capital gains is important because it can create these, what we call the asymmetric gains, meaning that in some startups, you can invest maybe 1,000 euros, and after a few years, it can be worth 100,000, 500,000, 1 million or more. Many cases like that have happened, okay? So, but maybe it's not worth anything. In any case, it will take several years for this to happen. The cash flow strategy will start generating cash almost immediately, or has the potential to, depending on the strategy, start generating cash flow immediately. All right. So keep this in mind when you are building your portfolio. All right. That's it.